Hello and welcome to Clarkenomics. In this video, we're going to study a very important thing called the federal funds target. So, there are two things really that we need to concern ourselves with here, rates and targets. So let's start off with the federal funds rate. Okay, so this is one of those terms that can be kind of confusing if you're just new to studying economics. It's a pretty simple idea though. The federal funds rate is the interest rate at which banks lend money to each other. So we've talked in the past in previous videos about how banks lend money to their customers, but what a lot of people don't realize is banks often lend money to each other for various reasons. We're talking about some very short-term interest rates. So sometimes, 24 hours, sometimes even less. So banks do a lot of like interlending and interborrowing, and the rate at which they lend to each other is known as the federal funds rate. Now, you might be wondering, well, why are we studying this? Because I'm not a bank, I might work for a bank, but otherwise, who cares? Well, the reason why the federal funds rate is so important, even though it's just the rate at which banks lend to each other, is because interest rates exist in an ecosystem, right? So when one bank lends money to another bank, that's going to influence the rate at which the banks lend to their customers. So there are so many other interest rates that are affected by the federal funds rate. Things like credit card interest rates, auto loan interest rates, mortgage interest rates, even though mortgages are longer term loans, all of these rates are directly or indirectly affected by the federal funds rate. So since consumers do use credit cards, they buy cars, they buy houses, that's why we need to know about the federal funds rate. Now, since we're talking about monetary policy now, what the Federal Reserve does to influence the economy, the Federal Reserve has a pretty big effect on the federal funds rate, but the interesting thing about that is the Fed can't directly set the federal funds rate. So, in the United States, which is a democracy, banks are private companies, and the Fed is midway between the private sphere and the government sphere. But long story short, the Fed cannot tell banks what interest rate to charge each other for loans. The Fed cannot set the federal funds rate. But what they do instead is they set a target for the federal funds rate. They come up with a number that they would like the federal funds rate to be, and then they manipulate market conditions, and we'll see how in the next couple of videos, to get the federal funds rate to meet the federal funds target. So this is the range that they want the federal funds rate to be in. Historically, the Fed would target one single interest rate for the federal funds rate. Today, and for about the last like 7 or 8 years, the Fed sets a range. So they say we'd like the federal funds rate to be lower than this, but higher than this. It's a target range for the federal funds rate to fall within. Now, how often does the Fed change this? Well, remember, the group within the Fed that sets monetary policy is called the Federal Open Market Committee, right? And there are 12 voting members at any given time. When the FOMC meets in Washington, D.C. 8 times a year, this is when they can choose to change the federal funds target. So sometimes they'll raise the federal funds target, sometimes they'll lower it, sometimes they'll keep it the same. They don't have to change it 8 times a year, but they have the option to. Or if there's some kind of emergency, the FOMC can meet, even more than 8 times a year. So everything going on with coronavirus, the FOMC has been meeting more frequently to adjust to market conditions. So how is the federal funds rate or the federal funds target more, accurately, a part of monetary policy? Well, let's imagine that the Fed lowers the federal funds rate. They lower the federal funds target. This is what we would refer to as easy money monetary policy. That's the term that some people use. Other people say expansionary monetary policy. If they lower the federal funds rate, and again, they can't do this directly, but they can lower the target, which lowers the rate, that's going to mean interest rates overall are going to fall. So interest rates for credit cards go down, for auto loans go down, for mortgages go down. And if interest rates are lower, people are going to want to borrow money. Remember, borrowers love low interest rates. So when people borrow more money, that means, consumers are borrowing more, firms are borrowing more because it's cheaper. And that is going to lead to more borrowing, which means more spending on behalf of consumers and more investment on behalf of firms, right? So firms are going to borrow more money to build new factories, more physical capital. Consumers are going to buy more cars, they're going to buy more houses, things like that. And when that happens, right, we've got consumer spending and investment spending increasing. That means the economy is going to expand, right? Aggregate demand is going to shift to the right. And if you remember what that means from another video, that means that the unemployment rate will go down but you might see an increase in the price level, right? Inflation might start to rise. So these are the effects of easy money, expansionary monetary policy. When the Fed targets a lower federal funds rate, that means borrowing becomes cheaper and everybody borrows more and spends more and the economy expands. Now the opposite will happen using what's called tight money. This is contractionary monetary policy. So if the Fed sets a higher target for the federal funds rate, that means interest rates overall are going to increase, which means borrowing is now more expensive for consumers and for firms. And since it's more expensive to borrow money, consumers and firms are not going to borrow as much, which means they're not going to spend as much. It's the exact opposite of the process we just talked about. That's going to contract the economy. Aggregate demand is going to shift to the left. And if you remember what that means, it means real GDP is going to decrease, which means unemployment is increasing. But inflation will decrease, right? The price level might go down or might rise by a slower speed. So remember that there are reasons why the Fed uses these different types of policy, right? During a recession, the Fed would use easy money because the unemployment rate is too high. So they use easy money to bring that unemployment rate down. During a time of bad inflation, right, people are spending too much money, this is when the Fed would use tight money policy, raise interest rates so that people aren't spending as much money, and that's going to decrease inflation, right? So that's how monetary policy is used. The Fed is augmenting interest rates to make people borrow and spend more or borrow and spend less. And again, they can't set the federal funds rate directly. So how do they affect the federal funds rate? It all has to do with something called the money market. Now, the money market's a relatively simple graph to understand. On the one axis, we have the quantity of money. On the y-axis, we've got the federal funds rate, which we were just talking about. And here is the money supply. Now, the money supply is always a vertical line, perfectly vertical, because it's not dependent upon the federal funds rate. In other words, the Fed sets the money supply, so it's not dependent upon any variable. The Fed just says, hey, we're the Fed, here's what the money supply is going to be. Now, what we mean by money supply, and this is going to become a more important idea even later, the money supply is how much money is available to spend in an economy. It's not necessarily how much physical currency exists, it's how much money is out there to spend, right? So the Fed sets the money supply, it's a vertical line. And then we've got the money demand curve. Looks just like any demand curve we've ever studied in economics. And this is the demand for holding cash. And it's downward sloping, it should actually make some sense here, because when interest rates are high, and we'll just say the federal funds rate stands in for all interest rates. When the federal funds rate is high, interest rates are high, you could put your money into the bank and earn more interest, right? If interest rates are high and you put your money into the bank, you're lending money to the bank, which means that you could be earning interest. So when interest rates are high, it means people don't want to hold on to cash, they want to put it in the bank and earn that interest. So when the interest rates are high, quantity of money demanded is pretty low, pretty light. On the other hand, when interest rates are low, you could put your money in the bank and earn interest, but you wouldn't be earning very much interest. So you'd opt for the convenience of holding on to more cash. So at low interest rates, people want to hold on to more money. At high interest rates, people want to hang on to less money. Because remember, interest that you could be earning is the opportunity cost of holding on to cash. So if interest rates are high and you're holding on to cash, you're missing out on more interest. The opportunity cost of having that cash is greater. So, long story short, downward sloping money demand, perfectly vertical money supply curve. And where those two intersect, if you've predicted this properly, is where we get the federal funds rate. So again, you can see that the Fed can't set the FFR, but they are in control of the money supply, and that is how they ultimately affect the federal funds rate. That's at the equilibrium. So let's look at some examples of how the Fed might conduct some monetary policy. So let's start off with easy money. Here's the graph we just had from the previous slide. If the Fed sees that the economy is in a recession, unemployment's too high, people aren't spending enough money, businesses aren't producing enough, the Fed's going to use easy money policy. And what that means is they are going to increase the money supply. On a graph, what that means is they're going to take it from like 50 up to something greater. Let's say they increase the money supply all the way up to 80, right? So a rightward shift of the money supply curve. Well, once they do that, that's going to result in a new equilibrium federal funds rate. Where's that going to be? It's going to be right there. And so the federal funds rate decreases. Interest rates go down, people borrow more, people spend more. So that's easy money policy. On the other hand, we might have some inflation going on in the economy, right? That leads to all kinds of bad stuff, and the Fed thinks people are spending too much money, and that's why inflation's happening. So, what they might do in this case is they might decrease the money supply. They can take money out of circulation, make less money available to spend. And if they do that, that's going to result in a higher equilibrium federal funds rate, which makes borrowing more expensive, which means people don't want to borrow and spend money, and hopefully that brings the inflation rate down. So again, during recessions, the Fed will increase the money supply to decrease interest rates. During recoveries with inflation, the Fed will decrease the money supply to increase interest rates. So although the Fed can't set the federal funds rate directly, this is how they do it, by augmenting the size of the money supply. And we'll talk about a little bit more how they do that in another video. So what have they been up to? Well, this is a graph since 2015 of the effective federal funds rate. Again, from the beginning of this video, the federal funds rate is the rate at which banks lend to each other. When we went through the Great Recession, it was pretty close to zero, right? The Fed was trying to encourage people to borrow and spend by keeping interest rates very low. As the economy started to get better and better and better from the end of 2015 up through basically January 2020, the Fed kept raising the federal funds rate, not because they were concerned about inflation, but if the economy got bad again, they knew they would need to lower interest rates to help out. And so they were raising it, raising it, raising it. And then once all the stuff with coronavirus happened, they dropped it back down almost exactly to zero. So they're keeping interest rates very, very, very low right now to try to encourage people to borrow money and to spend money to get the economy back on track. Whether or not that's going to work has yet to be seen. There's only so much they can do, but they're doing the right thing here. So looking at a little bit more data going back further in history all the way to like 1970, you can see that interest rates in the past have been very, very high. For instance, in the early 1980s, late 1970s, the federal funds rate was almost 20%. Well, what do you think the Fed was worried about to make interest rates this high? They were worried about inflation, right? People were spending too much money. So the Fed jacked up interest rates all the way up here to get people to spend less money. And then once the inflation was dealt with, then they brought interest rates back down. And you can see we've been on this little roller coaster until, again, the Great Recession of 2007, 2008, 2009. They cranked interest rates down to about zero, where they stayed for about 8 years. And then they brought them slightly back up, and then coronavirus happened, and they brought them back down to zero. So that's a little bit about the federal funds rate. Now, just one more thing about the federal funds target range. This is some data from 2014 onwards. The red line is the highest the Fed wants the federal funds rate to be. The green line is the lowest the Fed wants the federal funds rate to be. In other words, the space between these two lines is where they want the federal funds rate to be, and the blue line is the federal funds rate. And so, again, we talk about how the Fed can't control the federal funds rate directly, but they can set this target range. And if you look at the graph, you can see the Fed does a pretty good job of this. For the most part, the federal funds rate is always within the range where the Fed wants it to be, right? They're very good at manipulating the federal funds rate. So a good analogy that I like to use is the federal funds target is like setting the thermostat to a temperature in your house. And the actual temperature is like the federal funds rate. Once you set the target temperature you'd like in your house, your house doesn't instantly adjust to that temperature. It has to catch up, the AC or the heater has to kick on, and it'll eventually get to the temperature that you want it to be. And that's kind of how this works, right? So the Fed manipulates the money supply to get the federal funds rate that they're looking for to make the market where they want it to be. So right now, the federal funds rate, the minimum is zero, and the maximum is 0.25. You'll see they usually work in increments of about 0.25%, what we call 25 basis points. So that's a little bit about how the federal funds rate works, how the federal funds target works, and how the Fed uses these to conduct monetary policy. Thank you for watching.